John Kenneth Galbraith once said, "The only function of economic forecasting is to make astrology look respectable." I thought about that quote a lot this week, because 6 months ago, I sat in this chair and told you something was coming. I laid out the data, I showed you the charts, I walked you through the history. And then I said, quietly at the end, I really hope I'm wrong about this. I wasn't wrong. And honestly, that's the worst feeling in finance. It's not satisfaction. It's not, I told you so. It's that sick feeling you get when you're driving in fog. You see the shape of something in the road ahead and you think, please be a shadow. Please be nothing. It wasn't nothing. So today, we need to talk about what's actually happening. No hype, no doom, just the story, the full story. Because right now, most people are only getting half of it. Grab a coffee. This one matters. Let me take you back to 1972. America is flush. The post-war economic machine is still humming. And on Wall Street, there's a group of stocks that every serious investor has to own. They called them the Nifty 50. Polaroid, Xerox, Avon Products, IBM, Coca-Cola. These were the forever companies, the ones so dominant, so irreplaceable, that analysts literally said, and I'm not paraphrasing, there is no price too high to pay for these stocks. No price too high. PE ratios on these companies hit 60x, 70x, even 90x earnings. Polaroid was trading at 94 times earnings at its peak. 94! And the logic made sense. These were real companies, real profits, real dominance. But here's what the market forgot. Valuation is gravity. You can jump really, really high, but eventually, the ground finds you. By 1974, the Nifty 50 had collapsed between 60 and 90% from their peaks. Polaroid went from $149 a share to eventually filing for bankruptcy. Avon Products, the beauty company your grandmother loved, fell 86%. Now, why am I telling you this dusty story from 50 years ago? Because right now, in 2025, we're living through a sequel. And sequels, as any movie fan knows, are usually darker than the original. Here's where I need you to pay attention, really pay attention. Right now, the top 10 stocks in the S&P 500 account for roughly 37% of the entire index. Let that sink in. 37% from 10 companies out of 500. That is the highest concentration in the modern history of the index. And those 10 companies, their average PE ratio is sitting around 42 times earnings. The long-run historical average for the S&P 500 is about 16x earnings. We are at 2.6 times the historical average for the biggest, most liquid stocks on Earth. But wait, here's the twist that the bulls will throw at you. They'll say, these aren't your grandfather's Nifty 50. These companies have real earnings. They're growing. AI is going to change everything. And you know what? They're not entirely wrong. That's what makes this so complicated. Because here's what the Nifty 50 investors said in 1972, word for word, almost identical. These companies have dominant market positions. Their earnings are real. Technology is changing everything. History doesn't repeat, but it rhymes so hard, sometimes it sounds like the same song. Now let's talk about the part that actually kept me up at night, the bond market. The U.S. 10-year Treasury yield has been hovering stubbornly around 4.5 to 5%. That might sound boring, I know. Stay with me. Here's why it matters. When risk-free government bonds are paying you 4.5%, the math on owning a stock at 42x earnings gets very ugly very fast. In finance, we call this the equity risk premium, the extra return you demand for owning something risky versus something safe. Right now, that premium has essentially evaporated. You're being paid almost nothing extra to own stocks versus bonds. In fact, by some measures, bonds are more attractive than equities for the first time since 2002. And here's the villain hiding in plain sight: the Federal Reserve.
The Fed raised rates from essentially zero all the way to 5.25 to 5.5% in one of the fastest tightening cycles in 40 years. Then the market spent all of 2024 screaming they're going to cut, 6 cuts, 7 cuts, rate cuts incoming. Those cuts have been slower and fewer than almost anyone expected. And here's the brutal reality. Higher rates for longer means the discount rate on every future dollar of earnings goes up. Translation for humans? The math that made these valuations okay, the math built on near zero interest rates, is broken. The engine that powered the rocket is no longer working the same way. And the rocket is still up there. So what does this mean for you, sitting there, watching this, maybe with money in an index fund, maybe checking your 401k, maybe wondering if you should do something? Let's be real about what's actually happening. The Magnificent Seven, Apple, Nvidia, Microsoft, Amazon, Meta, Alphabet, Tesla. These 7 companies represent something we've genuinely never seen before. Nvidia alone, at its peak, was briefly worth more than the entire GDP of Germany. Germany, the 4th largest economy on Earth. And look, Nvidia is a spectacular company. Their chips are real, the AI demand is real, their earnings grew 122% year over year at one point. But here's the thing about spectacular companies. The stock market is not a business competition, it's an expectations competition. You don't get rewarded for a company doing well. You get rewarded for a company doing better than what people already priced in. And when 37% of the S&P 500 is riding on the continued perfection of 7 companies, the margin for disappointment is razor thin. We already got a preview of this in early 2025. When DeepSeek, a Chinese AI model, showed up and did what people thought only trillion-dollar American companies could do, Nvidia dropped 17% in a single day. That's roughly $600 billion in market cap, gone in one day. The largest single-day market cap loss in the history of financial markets. One day, one headline. That's the fragility we're talking about. That's what happens when the narrative is priced to perfection and reality shows up with a different story. Now here's what the optimists, and I want to be fair to them, will say. Productivity gains from AI could be genuinely transformational. We could be in the early innings of a multi-decade growth cycle. The US economy has surprised everyone with its resilience. Maybe earnings grow into these valuations. Maybe the gravity gets delayed long enough that the story changes. I'm not dismissing that. I'm holding it. Because this is not a movie where there's a clear hero and a clear villain. This is real life, and real life is messy. So here's where I land. Not with doom, not with hype, with something harder: honesty. The setup we have today, extreme concentration, elevated valuations, higher for longer rates, and geopolitical tension, historically has led to disappointing returns over the following 10-year period. Not crashes necessarily, not apocalypse, just math catching up with optimism. If you bought the Nifty 50 and held for 20 years, you eventually made money, but you also watched your portfolio get cut in half first, and you sat in the red for most of the 1970s. The question isn't just, am I right? The question is, can you survive being right at the wrong time? So here's what I think the smart move looks like, and this is not financial advice. This is just how I'm thinking about it. Diversification is not a dirty word. International markets, Europe, Japan, parts of emerging markets are trading at 11 to 13 times earnings. That's not glamorous, that's a margin of safety. Cash is not trash when rates are 4.5%. A money market fund paying 4.8% while you wait for better opportunities, that's a strategy, not cowardice. Risk management over prediction. You don't have to know when gravity works, you just have to make sure when it does, you're still standing. And most importantly, think for yourself. Not because the experts are stupid, but because the experts are all reading the same reports, attending the same conferences, and talking to the same people. The edge, if there is one, lives in the space between consensus and reality. I was hoping I was wrong. I wasn't. But being right isn't the point. The point is being prepared. Because in this market, in any market, the investors who survive long enough to be wrong, learn, and adjust, those are the ones who eventually win. Be one of those people. I'll see you in the next one.